All right, we're going to get things kicked off here. Thank you, everyone. Good afternoon. We appreciate you taking the time out of your busy schedules to be with us today. What we're going to do is just do a quick recap of 2023 markets. We're going to do a little bit of a 2024 outlook, examine some of the macroeconomic data from last year, talk about some trends, and talk about what to look for moving forward, and we'll finish off with some investor perspectives. And I expect, given what's happened over the past year and kind of where we are today, that there'll be a fair amount of questions. So I definitely want to make sure we leave enough time at the end for some formal Q&A. For those of you that are new, you do not know this, but those who have dialed in with us before know I always like to start these things off on a little bit of a lighter note. And so the beginning of 2023 specifically was a year of varying expectations, to generalize it. A lot of people had different opinions about what was going to happen in the markets, in the economy. There was no general consensus, I would say. We will talk a little bit about projections and expectations from some of the larger financial institutions and what they thought would happen versus what actually happened. But this is a continuing argument that happens on a daily basis. If you watch any kind of financial news or consume, financial news through any medium, you've probably heard the term bear market, bull market, and there doesn't seem to be a consensus of which is going to happen. And that's kind of how we started off last year. How the year finished, major index returns for last year. And so, as you could see, all positive returns, some more than others. Primarily, the big winner, so to speak, for last year was the Nasdaq composite, largely made up of growth related stocks, a lot of technology companies, many of which saw pretty rapid appreciation when we refer to their stock price specifically. So, the start to the year, pretty major level of uncertainty. How the year finished, and largely in the fourth quarter of 2023, we saw a pretty big run up in certain parts of the market. So how did that compare to 2022? Well, as you can see, I'll go back for a second. If you look at some of the index returns, NASDAQ, S&P 500, and Dow Jones specifically, in that order, NASDAQ, S&P, and Dow Jones, were that is the order of performance. What we see in 2022 is basically the opposite of that story, which is the NASDAQ, not as great of an experience. The Dow Jones, the best performer, silver lining, I guess you could say, with a negative 6.86 percent return, and the S&P 500 between the two, still negative, firmly double-digit negative returns. So what does that tell us? Naturally, the winner in one year and the loser in the other year could be the same exact stock, or excuse me, index from year to year. And the same can be true for individual funds, individual stocks. And so there was a lot of pessimism entering the year as a result of the things that we see here on this chart. What happened was we flipped that script and went the opposite direction on all of these major indexes. I talked a little bit about forecasts and expectations. I personally am not a big fan of these. We do consume this information from some of the largest institutions, and you could see there that not many of them were high on the S&P 500 target specifically for last year. So kind of a general measure of US markets. Most firms had a price target that was much, much lower, some cases 1,000 points lower than how it ended up. So, what do we do with this information? I think this is, in some ways, validation that these are, in fact, forecasts. They're based on assumptions. They're going to be revised throughout the year. And naturally, they're never 100% accurate. And so, the point of me putting this up here is to show that, not to show that everyone was wrong, but more importantly, to understand that when you're consuming this information, to some degree, you have to take it with a grain of salt. So talking a little bit more about winners and losers. So this doesn't get into the specifics of the individual stocks and the S&P 500 themselves, but it's a visual representation of companies that were in the green or gainers during that year and then companies that were not. What you'll see is that there are actually a fair amount of dots on this chart that hug that middle zero line. So that that translates to there are a shorter list of companies that actually drive or have been driving index performance. So when you turn on the TV and you see the SP 500 was up today or down today, the natural inclination is to view that as the total market, which to some degree is true. The reality is, and what this chart shows us, is that the outliers are actually telling the story in most of these cases. And this has been relatively true in recent years. Um, and so a small segment of the S&P 500 has been dubbed the Magnificent Seven. So a lot of big names that you're familiar with, the Microsoft, Apples of the world, um, heavily driving index performance. So when you look at what did the S&P 500 do over a trailing 12-month period from end of December of 22 to end of December of 23, the percent level change was 24%. What you'll see is that the bottom part and pretty much everyone else, with the exception of these seven companies, had about a 10% rate of return. And those magnificent seven, in quotes, had a 75% rate of return over that same time period. So when you look at the index and look at the market as a whole, uh, a lot of people will use measurements like the S&P 500 as um, some kind of barometer for economic conditions when sometimes in reality that performance can be heavily driven by a very short list of names. Another important point with that, and I'll kind of transition this into what have they done compared to the major indices over the past year. I think another point to take away from this is that this can also be true on the opposite side of things. So when we talk about downturn or losses in the market, a lot of times in some of these indexes, because of the way the market has moved in recent years, there has been a heavy weighting towards they become essentially very top heavy. And so when you're an index investor specifically, and you're picking an index and kind of riding that out, you are diversified, but it's important to pay attention to the percentage ownership that you also have or funds that you invest in have in these individual symbols and these individual tickers, because that will give you a good indication of how those things, how those investments could move over time. So let's break it down by individual sector and look at sector performance. So in the individual sectors, you'll see here, not a surprise based on NASDAQ performance, the technology sector was the big winner. Communication services, kind of a close second there. You see a lot of other parts of the market did not do very well, generally speaking. The energy sector being one, the utility sector being another. So when you break down the performance by part or by the sector of the market itself, you could see that the same story kind of applies here, and that there's been a very concentrated uh, run up of certain parts of the market, but not all. And so when you're looking at investment performance in general, if you're looking at a comprehensive big picture, you really don't see everything broken out in this fashion. But it's important to understand it because it not only gives you an indication of where the market has been, but can also give you indications of where the market is going. So let's talk specifically about December and the biggest movers on an individual stock basis. And the reason that I put this on the screen is specifically it shows in my mind shows a trend of what's going on in the market today. So more specifically, you saw on the last chart, technology was a heavy driver of performance in the markets. What you'll see on this is that at the end of last year, You'll see a lot of sectors listed there that look the same, but don't match what we saw on this previous slide. So one that stood out to me pretty significantly is this healthcare portion, which last year 2.06%. A lot of the names on this list are in the healthcare sector. And what you'll see is that the year to date returns weren't great, but in the month of December, they turned a pretty significant corner when we look at their price returns specifically. So what does that tell us? I'm not quite sure yet, to be honest with you, but I do think that that is an indication that certain companies in certain sectors of the market uh, should be getting our attention. Healthcare services being one of them. It's no secret that inflation in healthcare has well outpaced inflation in every other part of the market. And it's been pretty consistent for a long time. Healthcare and education have been well above long-term inflation averages for many years, and it's anticipated that that will continue. As a result of that, that could present opportunities when we look at it through an investment lens of how we view exposure to certain asset classes or certain sectors of the market in portfolios. The next big debate that kind of happens, and more so in our community, quite honestly, I think as individual investors, this isn't something that comes up around the water cooler very much, but it is something that does happen behind the scenes, and ultimately is portrayed in the philosophies that we may have as financial advisors and others in our community may have, especially when they're managing clients' money. Um, the growth versus value debate has been going on for decades and still continues to this day. The reality is that if you look at it in any given year, some years value wins, some years growth wins. Truthfully, over the past decade, growth has been a bigger driver of portfolio performance than value has. But typically, in a run up of a bull market like we've had over the past 12 plus years, that that is common. But more importantly, I think that there has been a shift in markets in general because of the introduction and the ease to which that the retail investor can get access to markets, ex, you know, access to trading, free in air quotes, free platforms and brokerage outlets that can be utilized. And so a lot of that has driven investors to have more control and more naturally more activity in the markets. And so the growth versus value conversation is something that happens in the wealth management world. And the reality is that there is no right answer. You could see here is of late, the growth story looks a little bit better. Um, in when you look at the market and kind of zoom out over a long period of time, typically a combination of the two ends up yielding a more favorable result depending on time and exposure. And obviously longer term performance is related to when you enter the market and how you get into specific investments. But beyond that, growth has been a big driver of um, of increasing portfolio wealth over recent history. And so as a result of that, I think that many people are driving money to that part of the market. Um, what what's problematic about that? When you look at growth stocks in general, and especially in recent history, there's been conversations around overweighting. You also have to look at general risk. How much risk are you willing to take? Are those companies that are growth focused and have great upside potential, are they profitable? Is there a realistic business practice or practical reason to own them from a business perspective? And so I think investors don't pay close attention to those types of things. I wouldn't expect many to do that, but growth versus value is something that's going to come into focus, especially as we flip the calendar over into 2024 and we're looking at types of investments, whether it's being more heavily growth focused or being more in the value space, which typically in layman's terms is going to be quality companies that are generally profitable, possibly undervalued, probably pay some form of dividend. And so how do we approach that? And as you could see, based on the discrepancies between the two, the high water mark and kind of the lowest on this chart here, there's a lot of opportunity in between the two. So, um, our philosophy is there's no one right answer, but these are debates that will happen, and terms that you're going to see get thrown around in the investment conversation um, as time goes on. So really quick, asset class performance. I kind of touched on this in the last slide, but US growth has been a big driver of performance over the past 10 years. The S&P 500 over the 10-year total return period has been less than that. The S&P 500 is a blend between growth and value. It's kind of a mix between the two, and that's why you're going to typically see that performance fall between growth and value. There are outliers to that, of course. There's always exceptions to that rule. But generally speaking, you're going to see that the index as a whole has kind of a mix of everything. Um, Interestingly enough, commodities, which hadn't been very attractive for a long period of time, and you could see the 10-year total return numbers on that, and you could see it there at the bottom of the chart, pretty much every other metric over the last 3 years has been relatively attractive. You'll see that in some periods real estate's a little bit more attractive and others small. And so if you were to draw a line between each box and kind of track its performance between each of these trailing periods, what you'll discover is that most of them don't consistently move in the same direction. They're good one year, not great the next. There's a lot of bouncing around that happens. And so that is a great indication of why, and I think a great story to tell as to why diversification matters in investing. It often gets lost in conversation because it's not as exciting as saying, like, hey, going back to those Magnificent Seven conversation, I bought seven stocks and they went up 75% last year. That's great. The same could be true on the opposite side, that they could go down 75% the next year. And so you really don't know what year you're going to be in. And as you could see from this chart, over the long term, some things are consistently good, some things are consistently bad, but depending on what period of time you catch, that's going to really frame a story and I think really tell a very clear story of how you feel you should be investing versus in reality how you should be doing it, which is through some level of diversification. So I've used a version of this chart in the past. I changed it a little bit, and primarily because um, we don't have an allegiance to any particular fund family, and I think so. In the interest of being fair and kind of looking comprehensively at the market, what we've done here is we've taken a diversified portfolio and really broken it down by benchmarks. So an all equity benchmark is going to look like and be an S&P 500 total return option. And so every step down from that, the 80-20, 60-40, 40-60, so on and so forth, they're going to incorporate other indexes as well, such as the Barclays Ag, which is just a metric of bond markets. And so what you'll see here in the story of diversification is that naturally, when you take some risk off the table, potentially, there is a decline in rate of return. This isn't always true, but over the past year, what we saw was that a lot of these risk adjusted portfolios kind of fell in line in a particular order that they normally do. There have been years of late where that doesn't happen always. One thing about this chart that was particularly interesting to me is at the start of this year, you have general pessimism. You have people that really aren't sure what's going to happen in the markets. And you see this little bunch here between March and May of 23, where all of these portfolios are basically layered right on top of each other. So if you were an all equity investor at that time, or you were an all bond investor at that time, your experience the first quarter of this year was virtually identical in a lot of ways, which I found fascinating and kind of interesting in that um, when you look at long-term diversification, the idea is that you want to achieve growth out of a portfolio, but you want to take an appropriate amount of risk based on what you're trying to do and really what the planning application of that account is. And so what I mean by that is, what am I using those investments for, and what do I need to get to achieve kind of the goals that I've mapped out for myself? And so there will be periods of time where all of these things look and feel identical. What you could see is as the year progressed, especially in the fourth quarter of the year, there was a clear separation that was created as a result of this. And so even in a calendar year, sometimes portfolios that look and feel very different can actually end up being very similar in the way that they react or perform in certain markets. Over time, and this is a very short snapshot, but over time, I felt like this was a really good illustration of what actually should and can end up happening when you pick portfolios like this and you kind of stick with them for a longer term period of time. If you react in the interim or in the short term, and you looked at this in April, you're like, well, this guy's got all equity and I've got all fixed income and we're doing the same thing. That may influence you to make a change, and that would in a lot of cases be a mistake. So the point of this chart is really to show you that diversified benchmark performances, when they look and feel like this, at the end of the year end up living up to their expectations. But throughout the year, you can see that that is not always the case. And so remaining disciplined through those periods of fluctuation and volatility, incredibly important. I couldn't get away from this presentation without talking about cryptocurrency. Um, so let's talk about it briefly. Uh, Cryptocurrency has been in the news. If you haven't heard, the SEC has approved the ability for a couple large asset managers to roll out Bitcoin ETFs. So this, in theory, makes cryptocurrency investments, excuse me, regulated in some degree and available to the general population. There's still a lot that probably needs to be worked out with that, but that ultimately is going to lead to a lot of optimism. You see, there was a little bit of a rebound here in both, well, not a little bit, a pretty significant rebound in the price of both cryptocurrencies listed here. Um, it doesn't seem that this is going away. There is a lot of um, there's a lot of interest, I think, in the investment community to see how this will play out, what the regulatory limitations of it will be. But know that it exists, and as these become more readily available, this we could see this becoming a part of the conversation. It kind of went away for a little while. It didn't come up in the news cycle. It just existed. It was there. Whether or not it is appropriate is 100% a case by case conversation. And how I'll tell you from our perspective as a firm, we're still not on board with the idea of using these options. Even though our compliance team is looking thoroughly into that and evaluating what outlets will be available or what should be available. There's a lot to unpack here, and so without getting into the specifics of what these ETFs will look like and what these investment vehicles will look like long term, it seems like this conversation is here to stay. So if you like the idea of cryptocurrency, you're going to hear a lot more about it. If you don't like the idea of cryptocurrency, you're going to hear a lot more about it. So do what you want with that information, but this is something that's definitely going to be making its way into the news cycles, no doubt, over the next year. So let's talk briefly about bonds and interest rates. So the Treasury yield curve, this is just a measure of different durations of Treasury rates, where they're at today, where they're at in their month over month. So that's what that third column in the table there shows. And so for a long time, and still relatively true today, um, we've had, and I say long time, basically over the last 18 months or so, we've had what's referred to as an inverted yield curve, essentially meaning that shorter term debt instruments, shorter term bonds are actually paying more interest than longer term bonds. Um, Typically, that's not the case. That has been the case for an extended period of time here. And so, what does that mean from an investor perspective? Primarily, you're going to be able to get a pretty decent rate of return without taking a lot of risk on over the long term in terms of duration and having to hold on to certain bond or fixed income investments. That could be a good or a bad thing. We'll talk a little bit in the next slide about how it's actually played out, especially with looking at what happened in December. But as rates come down, the top part of this chart ultimately becomes less attractive because it's not as good, or the interest rate payments are not as rich as they once were, and longer term bond instruments become a little bit more attractive. And so how has the market reacted to that, and kind of what's the story around that? Interestingly enough, the bond fund performance, if we look at the month of December, we see that treasury rates on the 1 and 10 year have kind of come down and came down over the course of the month. Something that was surprising to me, but makes sense, is that the 20 plus year treasury bond ETF from iShares, managed by BlackRock, actually had a total rate of return during that month of 8.67%. Now, if you go back to this chart, the 1, 3, 6 month, and even the 1 year are currently paying higher rates than 20-year treasuries. So why is this happening? The reality is that there is a great anticipation that rates will come down in 2024. At what speed, how frequently, all to be determined. Nobody knows the answer to that at this point. And I think even probably the Federal Reserve really doesn't have a concrete answer to that themselves. So why are we seeing this? Well, naturally, what's going to end up happening is as rates come down, those longer term instruments become more attractive because the rate will be effective immediately. You're going to see a lot of, there's a lot of folks that we've talked to that are heavily interested in money market accounts and other things that kind of move with the rate environment. If rates start to come down, those types of vehicles from an investment perspective become significantly less attractive, and they're going to come down immediately with those changes in rates. And so there's a consensus that if that's going to happen, if rates are at a place in the longer duration, looking at, in this case, 20 plus years, those will be a much more attractive option in a short period of time. That's the feel, that's the thought out there. And so as a result, what you're seeing is a decent flow of money going farther out on the yield curve and farther out in duration, which is driving performance with some of these bonds and some of these funds in general. So what does that mean from an investor perspective? If you are someone who's heavily focused on short-term investments, having money, cash in money markets, and it is for the purpose of long-term investing, it's a good time to consider reallocating that money and start to really consider how you can incorporate bonds, traditional bonds, into your portfolio over time so that you don't get stuck in a place where uh, you're now in a money market account that's paying 2-3% and everything else in the market is kind of paying a much more attractive rate. You'll be able to move money at a later date, but obviously timing the market is impossible. And I think it's not necessarily inevitable that rates will go down significantly this year, but I think it's a foregone conclusion that they will go down to some degree. I love this chart and I hate this chart at the same time. Um, this is really for people in our position. There's a lot of technical data that goes into this idea of a 10 to spread, and it gets the terminology gets thrown out a lot on various like financial and just general news networks. And what does this even mean? So essentially what we're looking for is gaps in the 10-year and 2-year treasury rate. What's that spread? And the lower that it is, that suggests an inverted yield curve. And so that tends to be some form of indication of a recession. Like traditionally speaking, inverted yield curves, especially for any extended period of time, usually signal that a recession is on the horizon. Coupled with that is the performance of the S&P 500, what that looks like. And what you'll see is that on a lot of areas of this chart, the two kind of track where you know, if we see a downturn or we see a period of time where the 10-2 spread is down, the S&P 500 usually kind of follows suit in the sense that you'll see those gray bars or recessionary periods. We see how the market reacted during those periods of time. Um, Most recently, obviously, COVID in 2020, you could see that very sharp drop. What's interesting to me is on the latter part of the chart, instead of having an inverse relationship, so an opposite relationship, these two lines actually kind of move in the same direction. So this is in some cases, I mean, in some ways, highly unusual how things are happening in the market and don't seem logical. And I think that's why it's hard for a lot of investors to kind of make sense of all this information. It's a lot of stuff. There's a lot of technical data that gets thrown out there and thrown at people, all different justifications for why these things are happening. And the reality is that it there's a lot of things that don't make sense and that's just speaking transparently. But there are a lot of reasons why we believe that the way things are today, does make sense to us. But before we get into kind of the economy and the economic data, this is another chart that talks about US recession probability. So you can kind of see again, gray bars are the recessions themselves. Um, this is a projection through the end of this year. So you'll see 12/31/24. So the probability of a recession through December of 2024 is about 63% right now, according to this chart. Is this right? I don't know. Um, the reality is that it's not a perfect chart, and you can see here that it does not accurately predict every single time a recession. And there have been times where it's spot on, and there are other times where it's not. And then eventually it does catch up and the recession probability is kind of like in the same realm as that gray bar. So a lot of this is based on consumer sentiment. It's based on some other economic data that they look at. um, Generally speaking, it's higher than it's been in years past, which is potential cause for concern. But we'll get a little bit more into the economic data now to kind of unpack what that looks like, figure out what's actually, on the horizon potentially, and things that you should be considering from an investment perspective. So let's talk about the economy. Probably everyone's favorite topic at this point, US inflation rate versus the Fed funds rate. So different measures of inflation there on that top chart. The bottom chart, the federal funds target rate, the upper limit of 5.5%. And so what we've seen is that inflation, the producer price index specifically peaked at about 11.66. The inflation rate, general inflation rate, peaked at about 9. And the core inflation rate peaked at 6.63. All of those metrics have come down considerably from their highs. These have been the metrics that the Federal Reserve has basically committed to using in their decision making. Whether or not, and I've talked about this in detail on previous calls, but whether or not you believe that that's a fair representation of what inflation actually is, I personally don't. I think that we all live in a world where we have our own inflation rate. If you're buying more groceries, if you're driving farther to work, any of those variables can ultimately change the true rate of inflation for each individual household. But this is the data that they've decided to use as their measuring stick. And so a lot of those things have come down pretty considerably, with the exception of core inflation rate less than the others, proportionally speaking. But this is what they're going to use. So if those things continue to come down, there's a decent chance that the Federal Reserve is going to make decisions about interest rates, specifically about potentially cutting those rates. Um, what effect that will have on inflation in the short term remains to be seen. I know recent numbers have come out and been a little bit higher than what was projected. So there's going to be a lot of this conversation throughout the year of like, let's make a cut, see what happens. Let's make a cut, see what happens. And so the general consensus of like some kind of rapid rate cut environment, I don't know that will come to fruition for those that are hopeful. for that. But these two data points will go hand in hand. It's seemingly been decided that these two will go hand in hand throughout the course of the year. So something to pay attention to and something to keep a close eye on. The other question is, are consumers pulling back? So top chart there is U.S. retail sales and real retail sales year over year. So the bottom chart is U.S. consumer sentiment. So what you can see is that sentiment on the bottom part of this graphic is lower than long-term average. So you saw that sharp uptick after primarily after record stimulus and a lot of COVID money getting pumped into the economy. We've seen a significant pullback of that in terms of consumer spending. And so it'll be interesting to see if rates do come down, how these numbers change. But generally speaking, even with the positive market outcomes from last year, anticipation of rates possibly coming down, consumer sentiment, excuse me, consumer sentiment really hasn't ticked up, closer to that average. It's still kind of been choppy and up and down, as you could see there from the end of the chart. And retail sales have kind of come down from their peaks in late 21 and off of 22. So um, the answer to this right now seems to be yes, to some degree. And we'll talk a little bit about why that is. A lot of it relates to the previous slide with inflation, but a big part of it is employment, wages. Are they keeping up with where we are from an inflationary perspective? So when we look at the left side, we're just looking at job openings, just looking at general economic conditions of unemployment, but also labor force participation rate. So you can see going back to 2000, labor force participation rate is still relatively low. It's really not far off from percentages perspective, but it has dropped off quite a bit since 2010, dropped off significantly in 2020, and really hasn't bounced back to that pre-pandemic level of participation. So there's a lot of reasons why. We won't go through and list all of them, but generally speaking, um, we're seeing people that left the labor force either because they could, a baby boomer generation that after COVID kind of got burned out with the way things were, could afford to potentially retire at that point. We're also seeing this shift to freelancing and a gig economy. So that's a big part of it as well. A lot more self-employed entrepreneurial type of jobs out there in the market. Some of it has to do with childcare and folks leaving the labor force to raise children, for example. So those are just a few examples. But what we could see is that the U.S. unemployment rate as of today, 3.7%, which is relatively good in the grand scheme of things. But there are still a pretty significant amount of non-farm job openings, and we don't have the same labor force participation. So it will be interesting to see how that plays out. The natural inclination is to say, well, more competitive environment, you might have to pay people more. Those are all natural answers to those questions. What we've seen is that the average hourly earnings year over year have gone up about 4%. We did see a spike, briefly after COVID. Then we saw a decline. We kind of arrived at this 4% number. And so when we talk about raising wages versus inflation, that bottom part of the chart tells a really interesting story about the real average hourly year over year earnings, which is essentially less than 1% or flat after we factor in increased costs, inflation, et cetera. So the question is, are workers getting ahead? Kind of, I guess, would be the honest answer to that. They are technically ahead, but it's really more of a break even feel. And like I said before, based on what you do and where you live and how you live your life and spend your money, that may very much feel like a negative number. Um, so this is something that will be particularly interesting, especially as we look at job openings, lack of labor participation. Will we see these numbers go up and in a competitive job environment where a higher demand for better wages will exist? Something else that will affect, I believe, retail sales and some of the other things that are going on in the economy is the amount of debt that we have as a country, and not the national debt, nothing to do with that. This is specifically as a consumer. So the chart on the left is the end of Q2 2022, and the chart on the right is end of Q3 2023. Sorry for both of these. So it's a typo. We'll get that fixed. But these are both 2023 charts. So Q2 23, Q3 23. What you can see is that, and we don't have Q4's data, so take into account all the other stuff that happens. A lot of spending happens in Q4 because of holidays, for example. The amount of US credit card debt that we have in US households has exceeded $1 trillion and continues to grow. And so in a high rate environment, that could potentially be problematic in that we're carrying a lot of credit card debt and those interest rates are not super attractive right now. Um, you're also seeing that mortgage rate debt or mortgage debt is increasing, and has increased pretty significantly as well, over the last 20 years or so. Housing prices have gone up. Cheaper money for a while was a big driver of that, but today we're seeing a sustained level of house or home prices and a sustained level of higher interest rates. So what that translates to with all of these conversations when we look at total household debt is that ultimately people are borrowing more, and that borrowing is costing more money. So that element of their cash flow on a month to month basis, we're seeing percentages increase in how much money, how much cash flow is being allocated toward debt in a month to month basis. The challenge with that will be ability to continue to pay that. Also, what wage growth will look like. How do you climb, in the credit card debt situation, how do you climb out of that hole efficiently when you're getting charged 29, 30% interest? But more importantly, how do you continue to save for the future? So I kind of look at this too through a different lens of like, there's a lot of conversations about retirement reform and a retirement crisis in this country. Um, Naturally, when you spend more money on other things that you cannot save that money now, and so that will translate to challenges when you're talking about trying to get to a place of financial independence and financial security. So something to keep an eye on. I will be curious to see once Q4 numbers come out how much difference there is between these charts. So let's talk about housing data. No secret that interest rates have gone up on mortgages. Housing prices have also gone up very rapidly between 2020 and 2022. Right now, as of the end of last year, 30-year mortgage rate was about 6.61%, 15-year 5.93. Those are averages. So there are certainly cases where they were better or worse. The existing home median sales price was 387,600, which was at a high at one point of about 414,000. But you could see, historically speaking, a pretty decent run up in those prices. Since 2014, basically almost doubled, um, and really kind of has doubled since that point. And so that ultimately is driving some of the conversations on the previous slide, which is having to go into more debt to be able to make homes affordable. And so this will be a real challenge if rates do not come down and mortgage rates do not decline in any significant way. There will potentially still be a challenge in 2024 on home purchases and what that market looks like in terms from a buyer's perspective. And there is some concern that inventory will remain low because folks that are stuck in 2 to 3% mortgages and 2.5, 3% mortgages that want to move but can't because of affordability issues will not. And that ultimately will lead to a shortage of available listings, which could present some challenges for folks if you're looking to if you're looking to buy a house. I'm in that boat. I'm in that camp right now. My wife and I are looking to expand, and as we're growing our family, and that has been a pretty significant challenge in this environment. So naturally, economic conditions will be affected by that. How much borrowing or how much capacity people have for borrowing, how that will translate to sale prices of homes. And historically speaking, as rates have gone up, prices have kind of gone down. It's not always true, but it's kind of the accepted norm. That has not been the case. Rates went up and home prices kind of followed with it. So again, very different market environment, and one that no doubt presents challenges in certain parts of your financial planning journey. Can't talk about recessions and what's going on in the world without talking about oil prices. So the current price of gas, you could see a peak here between 22 and 23. Current national average on gas prices at the end of the year, right around Christmas time, was 3.23 a gallon. Crude oil, $75 a barrel, was creeping up towards that $100 a barrel point. And so, what you see here on this chart, 2020, very brief, but nonetheless a recessionary period. You saw a pretty big drop, significant drop in oil prices. Uh, that also can be the case when we talk about the economy and recessions, and people pay pretty close attention to oil prices right now. Um, they're at a place that they've kind of been since the start of 2023, with anticipation that this could potentially go up at some point in the future. So another thing that you'll see and hear about, whether or not that will become relevant or useful, to be determined. But here, I think, is probably the most important piece of what we're going to talk about today, which is what all of this data aside, what should your perspective be as an investor? So, what to watch? Inflation, has it truly been tamed? Economic growth, will it continue to defy gravitational pull of higher interest rates? Corporate earnings, will they deliver on expectations? The disconnect between the Fed and markets, what that will look like, and the biggest of which is expectations. Last year was a perfect example of how a consensus expectations missed the mark, where it was very doom and gloom. Nobody was really sure. Recession on the horizon, everything not looking great. Market said otherwise. So that can happen and did happen. More importantly, if you look at this chart, these two graphics to the right, um, this is an US equity sentiment index. And so where we were the start of last year was on the left-hand side there, not super optimistic, not extremely pessimistic, but not on the optimistic side. And on the right side, that photo, now we're showing some extreme optimism with how we feel about the market. And so why is that important? I think it's important to understand how the people around you are thinking of the market. The market is a social environment, meaning that, it moves with the crowd in a lot of ways. And so if people are relatively positive about it, that could be a good reason to do certain things. It could be a reason to not be as optimistic as everyone else. So you could have a contrarian view to that. But it's important to know that how others are thinking, because ultimately behavior is going to be a big driver in how certain money moves in the market. It's also going to play a factor when we talk about timing. So, quote I've heard hundreds of times, but it's so important when we talk about just how we view investment portfolios. Sometimes the best thing we can do for ourselves is nothing at all. Period. The reality is that timing the market is probably one of the most challenging, almost statistically impossible things to do. And so this chart is a vision of last year, a visual of last year and what happened. And so what we'll see is that on a price level change, when we look at the S&P 500 over that 365-day period, it did pretty good. The reality is that if we started the year off and said, I don't really feel great about it, and I'm not really sure what's going to go on, so I'm just going to step away for a little bit and I'll get back in at a later date. Or you made that decision along the way at any point in time. What you can see here is if you miss the best 5 days, the best five performing days in 2023, your performance is essentially cut in half. If you miss the best 10 days, fraction of what the market did. If you missed the best 15, you didn't make any money last year. And if you missed the best 20, you lost almost double digits in your portfolio. The interesting thing to keep in mind with this is that good and bad days historically in the market tend to come in clusters. So it's not 10 random days throughout the year. It could very well be really good days in a week. Or if we saw the end of last year, there was, short bursts and periods of time where the market went on this really, really strong rally. And so not participating during those times ultimately leads to this, which is a lag in performance. And so the reality is that we can't time it. And if we do try to time it and we miss and we take a month off and that happens to just be the best month of the year, we've now, uh, I think, spoiled our potential for performance for the rest of the year and beyond. That performance, the difference between that best 20 days and just riding it out for the whole year, that's what we call lost opportunity cost. And that's money that and performance that you will never get back. The ability to recapture that is once it's done, basically. And so that's an important part of investing. And this is not just true for the S&P 500. This would be true for any portfolio. If you don't have a discipline approach or a philosophy to how you invest, the best way to change that is to do that, to become to subscribe to some form of philosophy or figure out what works for you and what's appropriate for the level of risk you're trying to take. Pick it, stick to it, and when it's appropriate to change it, you change it. But under no circumstances should we collectively, myself included, as a professional, be trying to time the market to achieve rate of return. Why? Long-term perspective. We're big on long-term perspective. This is just some data from our friends over at Y Charts, but a little quote there because everyone who invests and loves investing knows or has heard of Warren Buffett. One of his famous quotes: "Do not take yearly results too seriously. Instead, focus on the long-term averages." So, what are the long-term averages? The reality is, if we look at S&P price returns from 1950 until the beginning of 2023, if you hold on to a portfolio, and this is all different time periods, like every segment of 20-year period in that window, 100% of the time, 20, 15, and pretty close on 7 and 10, you'll have a positive rate of return. Now, I think full disclosure, that could be 1% positive. The point is that it's positive. And so the reality is that when we look at the long term, if you can pick a discipline or philosophy and stick to it, typically you're going to get to a place where you can achieve what you're looking to achieve. The hard part with all of us as investors is money is an emotional topic. It's hard to stick to your core philosophies when you see accounts going down by 15, 20, 30%, through the financial crisis. In some cases, if people are all in on the S&P 500, for example, your money got cut in half. It's a very easy, hindsight is 2020, to say if you had stayed in, you would have been part of one of the greatest bull rallies in market history. But at the time, you weren't thinking that way. And who would expect anyone to? But the reality is that the data, time and time again, shows us that if we can stick to a philosophy over the long term, generally, that's going to yield some form of positive result. So I think super powerful information. Important to note on the bottom half or the left side of this chart, in any given month, it's going to be positive 60% of the time, but there's going to be a lot of months where it's negative. And so the point of this is not to say like, let's play the probabilities in the short term. It's to say, let's zoom out and look at this thing in a comprehensive fashion and really understand what's going on. So concluding thoughts. It is in our belief that recession is inevitable, but definitely think that tempering optimism is a good way to approach 2024. Still have to really unpack and monitor what the ultimate effects of higher interest rates will be. There is some conversation about how long rates will be higher. There isn't a consensus on how fast and what they will be through the rest of this year. And so those are going to be point in time data. That's going to be point in time data that'll have to be analyzed and figure out how to kind of fold that into an investment approach for the rest of the year. Most importantly, stay disciplined and focus on the long term. 2023 was a great example of pitfalls of market timing. 24 is gonna tempt investors with FOMO, fear of missing out. If you don't know, sorry, acronym, but I think most people here know what FOMO means at this point. Um, don't get sucked into the emotional attachment to performance. I think having someone in your court, whether that's a financial advisor, someone that you trust, someone that you can get some level of coaching from, helping you kind of go down a path of disciplined approach based on your planning needs specifically. So, for those that are clients of ours, you know what that process looks like. Like for those that aren't, um, definitely something that we would recommend you finding out there in the marketplace to make sure that that you have that peace of mind and that you have a sounding board that can help you kind of navigate through where the market environment that we're heading into this year. Diversification is, I probably sound like a broken record saying this, but it's always important. It remains critically important and is probably a little more attractive. I talked a little bit about long-term bonds and those conversations. Higher yields, a reset of a higher yield, especially in the longer term, I think makes bonds a little bit more attractive, more so than they've been in years past, prior to COVID and prior to interest rate increases. So bonds will definitely be more of a consideration in the portfolio moving forward. Um, with that, I will open the floor to questions.
Ryan, Ryan, first question just came through in the QA said, what are your thoughts with it being an election year and how will that impact the market?
We did a presentation on this last election cycle called Politics in Your Portfolio. And so historically speaking, the short-term relationship between elections and markets tends to be a little bit more volatile because we as human beings are a little more volatile in our decision making. But the long story short is like when you look over any presidential um, stint in office, in most cases, with the exception of George Bush in the early 2000s and having that in 2008, in terms of market performance, almost all of them have been positive over their over their time in office. Even Jimmy Carter, who I know many people regard as, well, people have different opinions about him as a person and as a president, but generally speaking, the market actually was favorable over his time in office, believe it or not. So my advice, my guidance on that is I wouldn't get sucked into the politics too much and how that relates to the portfolio. Um, it will affect certain things, certain parts of the market, but generally speaking, it's usually short lived. It's kind of a flash in the pan conversation. And after that, things kind of get back to a place of normalcy, generally speaking, in terms of like how the market looks at economic conditions specifically and tries to be a leading indicator or kind of get out ahead of some of those things. So, um, we had this conversation in 2022. There was a lot of other stuff going on with COVID as well. So that was a little bit of a different packaging, but generally speaking, election cycles mean short-term volatility and don't really reflect on longer-term performance.
I know we're at 1 o'clock right now. We had another question that just came in. Really appreciate everybody spending the last hour with us. When it comes to bonds, do you recommend buying individual bonds or a bond fund?
Yeah, that's a tough question. Without kind of throwing out I'm not big on blanket recommendations, but I'll kind of map out the differences between the two. When you own an individual bond, the idea behind that is you buy that debt, let's say from a corporation or you loan that money to a corporation, government, municipality, whoever it may be, and they're going to pay you an interest rate on a regular cadence. And then eventually at some point in time in the future, that bond is going to mature and they're going to give you your cash back. The benefit of that is there's predictability, right? So you're going to get a coupon rate or an interest rate on that money that's predictable, that you can understand, that makes sense, that you don't have to worry about price fluctuation. In that case, you're really looking more so to, is this a strong creditor and will they pay me my principal back? Answer to that is typically yes or no. And bonds are given ratings to kind of measure that. So that's one benefit. The drawback can be liquidity with those, in that if you need to take out a large sum of cash and you need to sell a bond kind of mid cycle, sometimes that could be good. Sometimes that could be bad. You might sell it at a premium, you might sell it at a discount. All of that's kind of point in time. So that typically will present a challenge when you're looking at it. If you're a long term investor and you're looking at bond investments to generate income and be predictable, individual bonds could be attractive in that particular case. Individual bonds are not available to everyone. So if a primary source of your investing, for example, is in your 401k plan, in that case, you're going to be limited to some form of fund approach. And so in a fund approach, the benefit is you can buy fractional shares of things. You can just put in kind of flat amounts of money. You'll get proportional ownership in those funds, and you'll get interest kind of distributed to you, generally speaking, throughout the course of the year. And that can be reinvested to buy more shares of the fund, or that can just be taken out to use as income. One of the benefits is flexibility, liquidity. You can get out of a bond fund pretty much at any time. One of the drawbacks of bond funds is that when you're in a fund based approach, this is true generally across the board, but you are pooling your money with a bunch of other people. So if everyone else, a majority of the fund, no longer wants to be there and they want to get out, the fund has to come up with the cash to buy them or pay them out. Naturally, what happens is they may have to sell some investments, whether it's advantageous to do so or not. And so, what we saw during COVID, especially, is that low rate environment, run up of the stock market. A lot of bond funds took a pretty big hit because they had to raise a bunch of cash and push that out so that people could take that cash and move it into the equity markets. And so, big money movements can be a drawback on bond funds specifically. So you can, the difference in a bond, individual bond, if it pays at maturity, the principal gets paid back. You typically don't lose money in that scenario. In a bond fund, it's going to work like most other investments in that it can go up, but you can also lose money in that investment because there is some fluctuation in pricing in the types of investments that are owned. Sometimes those are available in both cases. Sometimes you might only have one option or the other. So it's definitely a conversation worth having, though. Individual bonds have become more attractive, especially with higher rates, and there are some practical reasons to do that, but it's not for everybody. It's not a fit for every single portfolio. So anyone who had questions about that, definitely want to talk to someone like myself, Devin, and someone in the financial or wealth management community that has some investment experience and can actually speak to providing one-on-one recommendations to you.
Awesome. Well, thanks for all the insights over the last hour, Ryan, and thank you everybody for tuning in today. We hope you have a great rest of the day. We will follow up with the recording of today's webinar with all of you. If you ever need anything from us, don't hesitate to reach out, and enjoy the weekend. Go Ravens.
All right. Thank you, everybody.